Have you ever wondered about the difference between secured and unsecured loans? What makes them distinct and why does it even matter? Well, today we're diving deep into the world of finance to unravel these mysteries. In the vast financial landscape, loans play a pivotal role. They fuel businesses, facilitate homeownership, and even make that dream vacation possible. But not all loans are created equal. They come in two major flavors: secured and unsecured. Secured loans, as the name suggests, are secured by an asset. This asset, often a house or a car, acts as a safety net for the lender. If you, as a borrower, default on your loan, the lender has the right to seize this asset to recoup their losses. This collateral-based nature of secured loans often results in lower interest rates and longer repayment periods. On the other hand, unsecured loans don't require any collateral. They're given out on the basis of your creditworthiness. Credit card debts, student loans, and personal loans are all examples of unsecured loans. Sounds great, right? Well, there's a catch. Since the lenders are taking on more risk, unsecured loans usually come with higher interest rates. So you might be thinking, why would anyone choose an unsecured loan? Well, not everyone has assets to use as collateral. And sometimes, the higher interest rates are offset by the convenience and speed of approval of unsecured loans. But wait, there's more to it. The contrast between secured and unsecured loans extends to the impact on your credit score as well. Both types of loans can affect your credit score, but defaulting on a secured loan can have a more severe impact. That's because the default gets recorded on your credit report and can tarnish your financial reputation. In a nutshell, the key differences between secured and unsecured loans lie in the presence or absence of collateral, the interest rates, the impact on your credit score, and the speed of approval. Secured loans are like a safety harness, offering lower interest rates but tied to collateral, while unsecured loans are akin to a high-wire act, no safety net, but quicker to get started. Remember, knowing the difference between the two can help you make informed financial decisions. After all, knowledge is power, especially when it comes to navigating the world of finance. So, the next time you're contemplating a loan, consider the pros and cons of both secured and unsecured loans and choose wisely.